Hey, welcome back, everybody. We're back with another episode to talk about the agricultural outlook during COVID-19. And to start, let's do a quick introduction. We'll go around, do an introduction, and we'll kick it over to Mike Helmar. Malieka, do you want to start?
Sure. Hi, I'm Malieka Bordigioni. I am a research manager with the University Center for Economic Development at UNR, and I also work on the FACRI project.
I'm Tom Harris. I'm sitting in front of the Gulf Esmeralda Courthouse. I'm a professor of economics at UNR, also director of University Center for Economic Development and a state extension specialist.
And Mike.
And I'm Mike Helmar. Like Malieka, I'm a research manager for University Center for Economic Development, and I'm also in the Agricultural Experiment Station for Nevada, and I also work with the FACRI project with Malieka. And today we're going to talk a little bit about some of the specific impacts of COVID-19 on the Nevada agricultural economy. We'll touch a little bit on the U.S. sector as well, because Nevada exists within those markets. But we're going to try to focus as much as possible on things for the Nevada producers. So I'm going to take us through a PowerPoint. So we're going to specifically deal with the Nevada cow-calf, dairy, and alfalfa hay sectors. It's not to suggest to anybody that we don't think the rest of the agriculture in Nevada is important. It certainly is, but we have we concentrate, we focus on those sectors. And also right now, we would love to be able to do the sheep and wool industry, but the data is just not available to be able to do a real good in-depth job because it's not reported like, for example, some of the cattle and dairy data is. It's just not as available. So we'll start off by looking at the cow-calf sector. We've talked about in the past the choke point in the supply chain, or the bottleneck, and that was processing. For cattle, it was the meat packing plants, and so that backed up into lower slaughter, and then more animals still sitting out there with producers weren't able to move, and they took some beating on prices. And if we looked through March, we were doing pretty well. I mean, COVID, the coronavirus, was kind of a story for China and Italy at this point in time, and it wasn't very bad here. We realized it happened, and we're starting to think about taking some safeguard measures, but it really hadn't begun to affect our industries and our economy here in March. And so our slaughter numbers were up even above a year ago. Our economy was great. And then all of a sudden things started to hit. We saw New York particularly get hit very, very badly, in a few other cities. And then it started to spread out into the hinterlands, into places where we had our meat processors, Iowa, South Dakota, Nebraska, Indiana, and various other places that handled the majority of our livestock processing, or a large part of it. And that happened very quickly. We saw COVID hit those facilities. Some of them just absolutely had to shut down, and shut down a big part of our meat production. And when that happened, ranchers could not move animals. I mean, it happened not only for ranchers, but for hog farmers, for sheep producers, and even into the poultry sector. But we really bottomed out. We took about 25% off of our slaughter in April from what we had in March, and May was about the same thing. Then they started to open up again a little bit. They put safeguards in place. They got protective equipment in there, and we were able to open up some processing. So as we got into June, we started to see animal slaughter and processing begin to increase. And this was all across the spectrum of all the species that this happened. So that in June, we were down a couple hundred or so from where we were a year ago. Having said that, that's the monthly totals. If we look at the last 2 weeks of June, we saw cattle slaughter and packing at or above levels that they were a year ago. So those operations are back pretty much to full operation. So that's where we sit right now. We're moving animals through the system and moving meat to demand sectors. But this is what happened to cattle prices. Now, as we look here, the solid lines are what we expected in January. We looked we ran numbers through there for January, and then we ran our models again with stuff out of FAPRI projections that we're part of in June, and we saw drastically different things. In January, COVID-19 was just, in fact, we didn't even call it COVID-19 then. It was just a coronavirus, and it was in Wuhan, China, and it was terrible, but it wasn't affecting us here, although now we know that it was actually here, but we just not very bad. So in January, we were looking at a robust economy. Everything was just moving right along as it should. And our prices were healthy, both on the retail side, and they were recovering from bottom part of the cattle cycle on the for suppliers. But then COVID-19 hit, and as we moved into it, we had those plant shutdowns. We pushed a glut of cattle out onto the feedlots. They couldn't move them from the feedlots into the packing facilities, and we couldn't move them out of cow-calf operations into feedlots. They just weren't there. So the prices dropped drastically. And so what we have here is, if we look at the blue line, that's the U.S. slaughter prices, and you can see that it was at the bottom in 2019. We thought, and it was supposed to start coming up. Well, with COVID-19, we're going to see a couple more years on the downside of that cycle, and it's going to be a tough row to hoe for producers. It's kind of thing, and it raised some real hard feelings out there too. If we look at the red line, those are the retail beef prices. The solid red line is again what we expected in January, nice, healthy, moving along. But the red line, dotted line, is what we expected starting in June. And you can see that those prices are up actually a little bit for 2020. That is the impact of the limited number of animals that move through the supply chain, and the constraint on beef production that hit commercial outlets. So we actually saw an increase in beef prices at the same time we were seeing a drop in cattle prices. This caused some real hard feelings by many people in the cattle industry, but there was no collusion by packers and processors that was in that. It was just the way the economics were working and that bottleneck that was in there. So we are seeing lower prices. It's take us a few years to begin to recover. And this is just what it's looking like for Nevadans, and it's just kind of the same image that you just saw for national cattle prices. Again, this is what we look like in Nevada. The solid line is our expectations in January. Cattle prices would have been moving up. This year would have been better than last year. Now we have a situation where this year will be worse than last year and will likely persist for another year before they start moving up. We have a weaker economy going out there that we talked about in the economics portion of a podcast that we just did. With that weaker economy sitting out there, we'll have a little bit of subdued demand for a number of years, and prices will be weaker all the way out. Now, having said that, they will return to higher than they were over the last few years, not as high as 2014 and 15, which were absolute banner years, but they will be higher than they have been since about 2015. And here's another piece of it for this coronavirus. We've talked about it. It's in other places in the world. And it's not just that it exists there and then the U.S. is absorbing all its own agricultural or even any industrial impacts. It's the global market that's hitting that. So we look at our trade position. We had expected a pretty sizable trade surplus for beef as we back in January, and that's a difference between the red line, red solid line, and the blue solid line. Pretty sizable, about 500 million pounds. That's a lot of beef. But now with this, we're not looking at much of a difference in our imports of beef by the U.S., particularly things like the Canada and the Mexican trade agreements will help keep beef flowing, particularly from Mexico into the U.S. So we're not expecting to see our imports drop, but what we're expecting to see is our export partners who buy from us reducing their demand for beef. And we're talking particularly our two biggest markets are Japan and South Korea. They're big, as are Canada and Mexico. But we expect to see that trade gap narrow over the next few years and finally recover by the time we get out another 4 or 5 years. So trade is another demand factor that will hit our cattlemen, that we're not moving beef into the international markets to the same extent that we expected to. All right, we talked in our last session a little bit about costs, and we did see some expectations of costs being lower in our January projections than they were in our June projections than they were in January, and that's true. Costs will be lower, but they still will be rising a little bit, although not very rapidly. If we look here in 2020, we actually see that our costs are a little bit higher. These are our costs for a cow-calf producer. Those costs will be a little higher. We've seen lower transportation costs because of reduced fuel costs. But one thing that we're seeing here is we're seeing feed costs a little bit higher this year than what we would have expected them to be. And you may scratch your head about that one because we're seeing lower grain prices, lower protein meal prices, a lot of lower prices. But one thing that we are not seeing is lower hay prices, particularly alfalfa hay. So our feed costs, particularly for some place like Nevada, whose winter feeding is heavily dependent on hay, we're seeing some higher feed costs. We expect that to be mitigated a bit next year, and those costs will come down. But even though our costs are going up relatively slowly, and even down a little bit this year overall, in total, our prices are down much more than that, and we're going to squeeze our producers. We're going to start looking back in 2020 and 2021 profitability to be a lot like it was just prior to the last recession. We're not going negative yet, although that's very possible, but we are seeing profits greatly be greatly reduced. And then we begin to recover to moderate profitability over the next few years. Now I want to take a look at what this means, for our livestock herds, for our cattle herds in the state. Over the last 20, 30 years, we've seen cattle inventories drop in Nevada. There are a number of reasons. Some of them are just like the number of producers has dropped. We've seen some concentration, but we also see a lot of younger people that don't want to take over the ranch and things of that nature. And we've seen that drop. We've seen the available grazing land be reduced at some points along the way. Not steadily, but at some points it took some reductions for a couple of reasons. Some of that has been environmental, with protection for species like the sage grouse, the desert tortoise, that we've taken some of that land out of production, and that hasn't returned. And that's kind of the state that we're in right now. We don't have as much grazing land as we used to, and Nevada is highly dependent on federal grazing land, and that's from the BLM and to a lesser extent from the Forest Service. So our grazing land, those allotments, which make up the majority of grazing land in Nevada, are not, that's not increasing, and many of them are taken up. There's not a whole lot of slack in that system, so we don't have the land to expand into. And given that, the economics that we've just looked at aren't conducive to expanding the herd in the next few years anyway. So for that matter, for those reasons, we're going to continue to limit our herd size to between 450 and 500,000 head on the Nevada range. So expansion for cattle in Nevada doesn't look like there's not that much to induce expansion in Nevada cattle. At this point, I would like to, if anybody has any questions about the cow-calf ones, we can take some now, or we can wait until the end. We kind of went through it briefly. Nope.
Nope. All right, no questions. Moving on.
Okay. Now we'll talk about dairy. I'm talking too much. A lot of the similar factors that hit our cow-calf industry are also hitting, or hit the cattle industry or the livestock industry in general in the United States, meat production. The general factors are also hitting the dairy sector. They're not all identical. They're not exactly the same, but a lot of things are hitting it. The shutdown in processing that occurred because of COVID cases in the plants, and then lower profitability for dairy. But let me back up. The processing plants that closed down pushes milk back out into the market that can't be delivered, can't be used. But here's where milk is a lot different from the livestock industry. The livestock industry can hold animals for a while. They can hold it on the farm. The dairy industry cannot. That milk happens on a daily basis. The cows get milked on a daily basis. You can't not milk a cow. It takes a while to dry them up or to reduce your herd size. So that milk came on a daily basis, and it just wasn't being able to move into the processing facilities. And there's a couple of reasons for that. One is COVID kept the processors closed. Another one is that as we closed our schools, we no longer had the breakfast and the lunch programs taking milk off of the processors. So there was a glut of milk there, and they just weren't able to take any more. They couldn't process anymore, couldn't bottle anymore. Milk was just sitting out there. So we heard stories of milk being dumped in parts of the country. And that's true. In some cases, milk was actually being dumped on the ground. Those are the stories that the media just likes to show us, because it makes everything look drastic. And indeed it was drastic. But there's also other forms of dumping, which, if you consider dumping to be anything not going to the normal plants or bottlers, then yeah, there was dumping. There were other uses. There was some on-farm use. There was some milk feeding to feed calves, and they held calves for a little longer, and things of that nature. But basically milk was not being utilized for the general reasons that it normally is. And for that reason, then we saw steep drops in milk prices. We saw prices go from $20 a hundredweight to 10, 11, and sometimes even less, depending on the type of milk it was, in a matter of a few weeks. So milk prices dropped very, very drastically, and they're down they're still down, and we expect them to be down for another year. I'd like to back up a minute on this chart. That dotted red line that shows into 2020, we still expect milk prices to be low. There's a little bit of uncertainty around those projections. If we look at what milk prices have done in the last month, they have, or month and a half, they have increased, and they're actually relatively high now as processors have begun to reopen, and there has been some supply rationalization there. So whether we're going to be continue to be low for another year or not, I don't know. Now, we have had some prices supported because the federal government has taken milk products off and stored them. Is that going to continue to happen? Probably not, but I'm thinking that the upside potential on milk, it may be for 2021 a little more than what's in this chart, although I wouldn't expect it to be $20 or $25 a hundredweight at this point. And this is just the same chart. This is how we're looking at in Nevada, and I wanted to talk about Nevada specifically a little bit. One, because that's kind of what we're talking about here, but two is because our milk uses is a little different than in a lot of other parts of the country, with the particularly in northern Nevada with the whole milk powder plant in Fallon. If we look at the blue lines, the blue line is a Nevada Class 1 price, fluid milk. The red lines is a Class 3A price. That would be the milk that goes into processing at the powder plant. You can see that the dotted lines, that is what we expect in June as opposed to January, are considerably lower than what they were than what they were previously. Again, for a lot of the same reasons that we just went over for the national level. In Nevada, the processing, particularly in northern Nevada, most of the processing is for the whole milk powder plant. That does have some short-term benefit, that there were contracts with some of the producers, and the plant continued to produce, hadn't shut down completely. So that will help hold some Nevada prices up. But for the most part, our Nevada producers, our Nevada dairy producers, are in the same boat as most of the national ones, even though our dairy products are a little different in the state. And dairy producers then are going to face a tough few years. Last year was a pretty decent year, and this year we'd expect it to be a pretty decent year, and have prices be able to support the dairy industry relatively well over the next 4 or 5 years. That has kind of been undone with COVID. I want to take a look at the blue lines are net revenues. That is revenues, the value of production, milk, and also including cattle sales that dairy producers have, cows and cull cows and things of that nature. That net revenue is at over all variable costs: feed costs, vet costs, transportation costs, services, fuel. It's over those, and you can see that the dotted blue line touches zero for 2020. So we're basically saying that for our dairy, producers aren't going to make anything on average over the year. Now they're making money now, but on average over the year at the prices we expected in June, we didn't expect them to make much. If prices stay where they're at now, that they've gone high and can help mitigate some of this, then they might make a few bucks, but they're not going to be whole. They're not going to be like what we expected in January. The red line, this has some policy implications. Again, the solid line is what we expected in January, and that is those dairy returns over feed costs. Now, again, this includes the sales of cattle, so it's not just a margin. It's not just a milk margin over feed costs, but it's the total returns over feed costs. We expected those to be $7.50 a hundredweight or thereabouts, and then about $8 on out. Now we're below $6 a hundredweight are our expectations, and then recovering to about $8. But if you just want to take the value of the milk over that, you'll need to take another $1 or so a hundredweight off of that, so that the margins over feed costs will prompt payments under the dairy marketing program. And what we're looking at here is an annual average. That market program, that margin program runs on monthly stuff so that it can dip for a month or two and payments are made. It doesn't have to be for the whole year. So the implication is that during some part of every year, particularly in the spring when milk prices are reduced, that there will be payments made under the dairy margin program. This year, there definitely will be at almost all margin levels. You can go from $4 up to about $9.50 on that, depending on how much of a premium you want to pay. So that margin program will be paying out this year, definitely, and probably some during some parts of all years out through 2025. So the recovery, what the producers are able to recover over their feed costs, is just very inadequate. It won't cover other variable costs either, which is why we showed zero profit this year. So those margins are extremely low for dairy producers, and they're going to really have another tough few years. And this is just kind of another look at that. This is kind of similar to the chart that we saw for the cow-calf. We have feed costs, other operating costs. Excuse me. I'm sorry, forgot to turn that off. Other operating costs, and then above that is the gross value of production, including cattle sales. As you can see, in 2020, the costs and the value of production, or the gross revenues, equal each other. That is, there's no profit. In 2021, they're very small. Again, where'd my cursor go? They're very small, and it'll take into 2023, 2024 before we get to move back into some normal profitability for dairy producers. So dairy is really going to struggle with profits over the next couple of years. And that certainly has some implications for how dairy is going to be able to expand. Now, we brought that milk plant in here. We were hoping to be able to expand dairy production to meet the needs of that plant, plus still service our in Northern Nevada, plus still service our model dairy, our bottler here. We had pulled the milk that we sent to California back into the state, but that still wasn't enough. So we needed a herd expansion to about 40 to 45,000 head, up from about 30,000 when we started this thing back in 2016 or 17 or so. So we were expecting to see a large increase in dairy expansion. We haven't had that yet. The economics just haven't been there. And even so, even less so right now. If you look at this period right here, that we're at about 32,000 head going into 2020. And we stay about there. We're pretty flat that year. We're not seeing any expansion that we were hoping to see this year. And it will take a few years before some of those economics come back to where we can expand. And even at that, with some modest dairy profits, we're not looking at being able to increase our herd size adequately to completely supply that whole milk powder plant, unless something drastic happens that we move in a lot more producers from out of state. And right now, that's not happening, nor has it been happening the last few years. So this is where I kind of want to talk about the trade side a little bit. And this is where I kind of want to end the dairy conversation for Nevada. The Chinese market, when we start talking about Northern Nevada dairy particularly, the Southern Nevada dairy not so much. They service a lot of processing in Southern California. But the Northern Nevada dairy industry, with that milk powder plant, is highly dependent on whole milk powder trade with China. Well, China's not importing very much anymore, both because of COVID and because of the economics and trade disputes. But if we look here, if we go back, the blue bars are the volume in terms of metric tons of whole milk powder, and the black line is the value of that. And you can see that 2017 and 2018, it was very healthy. It was growing. We really were making inroads into that Chinese market. We had help from, in 2018 from New Zealand, who had to shut down one of its plants. They're the dominant whole milk powder producer and trader with China in the world. Then as we started moving into the end of 2018 and 2019, that market dropped off the cliff. That market completely disappeared. One is competition with New Zealand. They reestablished themselves and because of getting their plant issues straightened out, and because of the exchange rate. The U.S. dollar became very, very strong and made us less competitive in a lot of foreign markets. That was part of it. And the other part of it was China. China is in and out of a lot of markets. Well, they completely left us out of those markets. As you can see from the middle of 2018, and here the last bar is the first quarter of 2020, our whole milk powder exports to China are very, very small. So we've lost that market. That's a real blow to Northern Nevada dairy producers. Now, that powder plant can also make skim milk powder, and that market is a lot bigger and doesn't necessarily have to depend on foreign markets. That market's a lot bigger than for the whole milk powder plant, but there's still the issue of what you do with the butter fat. So for right now, that Chinese market has disappeared, and if that plant is going to help our Northern Nevada dairy producers or support them, I don't mean help, but support them, then they have to go to an alternative market. And that's it for dairy. I just kind of wanted to leave you that right now, the Nevada producers, the Nevada situation is not a particularly rosy one sitting out there, and our dairy producers are in for some really rough times going forward. Comments, questions on this one before we wrap it up with alfalfa?
Mike, I think we might just wait at the very end.
Okay, good enough. Oops. Okay, so we'll move on briefly to alfalfa hay. One of the reasons I wanted to cover alfalfa hay is it's our biggest crop in Nevada. And basically hay in Nevada, although we export some or ship some to California for horse hay because our hay is very high quality. And some of it gets traded overseas as well, again, because it's a very high quality hay. A lot of it ends up on the hoof with our beef cattle, and also it ends up in the milk pail with our dairy cattle. So it's a major thing, and our livestock industries are really dependent on our hay industry. So I just want to take a look at what has happened with our hay and forage prices in Nevada. And now I'm only looking at this year's projections, because we don't have a big drop like we saw in some of the other commodities to compare it to January. It's not very interesting. The red line is our alfalfa hay prices, and our blue line are our other hay or grass hay prices. The black line down here are private grazing fees. That is for producers who lease from private landowners, lease private pasture out. And as you can see, they kind of generally follow each other. The private grazing fees have been quite low the last few years. There's been adequate grazing. We got more moisture out there, and the private grazing fees have been a little lower. Our hay prices have kind of recovered from where they were back in 2016, and are $170 to $170 a ton last year. This year for our grass hay, they're about the same. But the interesting piece of it, and this is one of the things I want to cover with alfalfa, is to this point this year, alfalfa prices have spiked up from where they were last year, and are holding higher. So what's going on here? Why are the hay prices up in Nevada this year? Other feed costs are down, but hay prices are not. Well, let's take a look at our weather so far this year. Well, first of all, it's been dry, but most of our hay is irrigated. But it was cool. We had a real cool and a late start to a growing season for our hay. And our first cuttings haven't been as large. I want to talk about this again in a little bit. So our hay production, our hay supplies are not all that great. And for that reason, alfalfa hay is maintaining a premium over last year. Now we're expecting to see those prices come down next year if we can get the cuttings in and made. But right now, early in 2020, or in the first half of 2020, I should say, our hay prices were higher than we ordinarily would have expected them to be. And let's talk again. I want to talk about our hay supplies, our hay cuttings. And look at our Nevada hay acreage. And this is acres harvested. Now hay's a perennial crop, and so we don't plant it every year. If you're replacing a hay stand, then you replant it. But for the most part, you don't. We can see that if we look throughout there, hay acreage has been up and down. It was up about 440,000 hectares. We're in the U.S. About 440,000 acres last year in the state, which was a recovery from where it had been in previous years. And our expectations, if we looked at the USDA prospective plantings report that comes out on March 31st every year, we can see the green bar on the right that it was expected to be about 440 or 450,000 acres again this year. So far, that hasn't panned out. All right. Now, first of all, the prospective plantings report for Nevada, they seem almost every year to report pretty much what they did last year. And then they don't always do that. So that's not, you can't really hang your hat on the prospective plantings or the planting or the harvest intentions of producers. But the other thing is, we talked about the hay cuttings being down this year. If we looked at the bar just to the left of that, this bar here, that we can see that it is well below the 2019 bar. And this is what would be implied by our harvest up through June for the first cutting in northern Nevada and a couple cuttings in southern Nevada. So we're down to about 335,000 hectares. The first cutting, through June, hay acreage harvested was 175,000 acres compared to 215,000 acres a year ago. So we've got a lot less hay being harvested there. So that's one reason our supplies are constrained, and that's one of the reasons we saw that bump up in those hay prices this year that were below early expectations. Will those come back? I don't know. How much hay land is sitting out there that's getting irrigated? How's the weather going to cooperate with us remains to be seen. What will recover. But for the beginning of the year, we're low on our hay supplies. So this is where I want to leave it for hay, and let's look at the profitability for hay producers. That in 2020 we did see higher prices, but our expectations are for lower yields that we've seen in 2020 because of what we didn't get earlier this year. So that even though we had higher prices, here's our 2020, our gross revenues are expected to be a little down from last year because we're not doing it on the quantity side. We're doing it on the price side, but not getting it on the quantity side. And then our revenues are expected to be relatively flat throughout the whole projection period, while our costs, which are down in 2020 mostly because of fuel costs, while our costs continue to go up. So we're getting to see that hay is not going to be a perennially real profitable crop unless something happens with the prices out there, that the producers will eventually be squeezed in this production. Now, having said that, a lot of our hay producers produce it and feed their own. So they can absorb a cost price squeeze. But if they're buying their hay, then they're going to feel the squeeze, and or rather, if they're selling their hay, then they're going to feel that squeeze out there. Okay, so now that is the end of where I want to take it. It's not a real rosy outlook for anything in Nevada agriculture. We will have a couple of years, particularly when we get out to 2022, 2023, 2024, where we'll start to see the agricultural economy in Nevada become adequate. But for a while, our producers are going to be in a real tough situation. Questions, comments?
Thank you, Mike. In regards to dairy, I know you mentioned the Fallon plant being sort of the powdered dairy and the outlook not looking good. Reading the tea leaves, what are you looking at as far as after this year? Is it too soon to say?
Well, okay, no, I mean we can make some guesses. Right now, I'm going to say any guess that we have after this year depends on what happens in the rest of this year. And by that, I mean, what's going to happen with the pandemic? Right now, we're seeing a lot of places around the world are doing very well. The Europeans are doing well. Chinese, we're not sure. Some other countries we're not so sure. We're seeing some increased cases in some other countries, but not to the extent that we're seeing in the U.S. Okay, we've really kind of taken several steps backwards on this thing, and without getting into any politics or any nasty comments, we'll just say that's what's happening. So we're uncertain about what's going to happen with the pandemic, particularly in the U.S., but also in other places of the world too. If that pandemic subsides and markets get back to normal, economies start being driven again by business cycles and not by the pandemic, then we can expect to see demand for all commodities begin to increase, and that would include our whole milk powder in the plant. Is China going to come back and buy? Well, they can't do any worse really than they are. I don't mean worse. I mean they can't buy really any less from us than they are to a very large extent. But if the pandemic subsides, the economies start growing, then yeah, the stage is set for growth for those things. In whole milk powder in China, they processes it into other things. But even if China doesn't buy, as we start looking at our dairy products, we make skim milk powder, and skim milk powder is used in a lot of processing of other products. And as our demand for those products increases and that market increases, then if the milk powder plant in Fallon goes that route, it will have a market. I mean, in a market more than just what we had back in the 60s for non-fat dry milk, which was when we were camping, my mom used to buy it and make us use it on our cereal, but we didn't like that. But the processing industry is a lot bigger than it used to be, and there's a place to absorb more milk powder in there.
Mike, the interesting thing, you look at 2012 and 14 is when we had our drought. We may have a unique thing, a pandemic I know this year's going to be a drought. There's always worry about drought. What in the world would that do? You have a combination like that. We don't know, I guess.
Okay, we'll kind of talk about it in the context of all the commodities we've talked about here. One, the drought is, let's start at the top with the cow-calf. The drought will have less density of grass out there on the grazing lands, and if it gets severe enough, then might have to have some supplemental feeding, not just in the winter, but some supplemental feeding of cattle. in a time when we've already got constrained hay production. So that will increase those costs. It would also increase the hay price too, but it really put a strain on what hay supplies we have. So there will be that. That drought will also do several other things, but one important thing is the thing that we're already starting to see is the fires.
Mm-hmm.
If we have fires, if we have big 50, 100,000 acre fires, which we've seen in the last few years in Nevada, that's going to go ahead and burn up some allotments, and that grazing land is going to be out of commission for 2 years, perhaps more. So it's not just the density of the grasses, but it's some ranchers may actually be burned right off of their allotments. Again, if their livestock survives, then they'll have to do more supplemental feeding. For dairy, water constraints. Right now, we're irrigating it. We have surface water, I think, to get through this for dairy operations, for the cattle to drink and all. I think the water may be there. I've not heard about water allocations being cut yet, but it could come to that, particularly if the drought persists in next year.
Mm-hmm.
And then again, for the hay, if the drought becomes severe and there's not enough water to irrigate it, we may see some land like we did in the last drought just not get harvested. So drought doesn't just impact one thing, it impacts everything across all facets of agriculture in Nevada, and it affects them negatively because we need water.
Well, I think that in alfalfa hay, if you're in Fallon, which depends on surface water, you can get your water cut. If you're in Eureka, as long as the aquifer holds out, groundwater those producers should be in pretty good shape, but there's still, I know there's some problems there too. But yeah, that'll be the unique thing of the drought.
Yeah, and I think it will be even more acute next year if it continues. There may be the surface water to get through this year.
Yeah.
But if it persists next year, probably not. Then that's when I'd expect to see water allotments being cut.
The only other thing you're talking about is about the international. I was talking to a farmer in Fallon, and he was setting up his contract. He was selling all of his alfalfa to Egypt.
Really?
Yes.
Now that's interesting.
Yeah. Well, you think, I think unfortunately people think agriculture is like Green Acres. No, it's a lot different.
Yeah, because I know that a lot of our hay went west across the Pacific.
Mm-hmm.
I didn't realize it was going into the North African market.
Right. That's all my questions.
Yeah.
All right. Any last thoughts? Okay. Thank you so much, Mike. Very informative. It sounds like we have a lot of work to do in terms of where we're at.
Yes, we certainly do. It's not going to be an easy few years.
Be a little bumpy. Yep.
Yeah.
All right. Well, thank you so much, and great to see everybody again today, and we'll be in touch.
Okay. Take care of yourselves and each other.
Thank you.